their way through this particular period. So firstly, we're going to look at what is insolvency and how do we as accounting professionals best support our clients struggling financially. We'll then move on to the legal obligations for directors and advisors around businesses and advice around trading whilst insolvent. In terms of the formal and informal solutions, we'll look at a number of different ways you can approach those situations with struggling clients. And we'll touch on the key professionals that are supporting businesses through insolvency and some of the mental health concerns that arise out of these particular circumstances. So, fun fact number one for today's presentation, Section 95A of the Corporations Act defines what solvency is. So effectively, it notes that a person is solvent, or a company or entity is solvent if and only if that person is able to pay all their debts as and when they become due and payable. So it doesn't actually define insolvency. It just effectively says if you're not solvent, you're insolvent. So insolvency is more commonly expressed as the inability of a company or an individual to pay their debts as and when they fall due. There's obviously been a number of circumstances that have arisen recently: Virgin Australia, Sea Folly, Tiger Lily, G-Star Raw. I could keep going for hours in terms of the number of companies that have gone into an insolvency process of late. So it's not uncommon given where we are at the moment, and it shouldn't be looked at as being a failure for all intensive purposes. It should be looked at as a way of trying to resolve a situation where some things are definitely out of most business leaders' control at the moment. Who would have thought that the second biggest airline in Australia would fail because the government closed the borders one day and hasn't reopened them? It's not necessarily a failure on the people that are involved in the businesses' behalf that they've entered into these circumstances, or sometimes it is, but we just need to be mindful that it's unprecedented times that we're going through, and we need to treat it accordingly. So now that we've defined what insolvency is, what are some of the signs that a company or a person may be insolvent? There's a case called Asic versus Plymouth, which is effectively the gold standard when it comes to the court's definitions around what are signs of insolvency. This case was handed down some time ago, and there's a couple of things that may not be relevant just because of changes in technology, but the vast majority of the signs that are indicated there on your screen are indicators of insolvency, and we'll just work through them quickly because it's not necessary that all of these signs are evident in a company or a person's position for them to be insolvent. It only takes one or two in some circumstances it may be three or four. It's just dependent on the different scenarios that people find themselves in. So the first one's continuing losses. Obviously, we all know as accountants that if you keep losing money, there's a problem, and generally that money tree doesn't continue to sprout dollar bills. So at some point in time, there needs to be a consideration as to whether you can continue to fund those losses. A liquidity ratio of below 1 is another sign. So effectively, if your current assets and liabilities are below 1, effectively the measure, your assets divided by liabilities is below 1, that's an indicator of balance sheet insolvency. If you've got overdue Commonwealth and state taxes, the court found in a lot of circumstances where companies are insolvent, they tend to have overdue Commonwealth and state taxes. The fourth one listed here is a poor relationship with their funder or their inability to borrow further funds. So if there's a breakdown with their bank or their credit providers, even their suppliers in some circumstance, which we'll get to in a second, that in itself may be an indicator of insolvency as well. No access to alternate finance. So generally, if you've got a poor relationship with your funder, there's a reason for that. And if that is the case, then it's likely that other funders aren't going to be interested in providing you credit either. Number 6 is suppliers placing the company on cash on delivery or otherwise demanding special payments before resuming supply. Again, that's kind of an Insolvency 101 indicator. If your clients aren't prepared to deliver goods to you on your normal 30 days, 45-day terms, then that's an indication that they've been burnt or that they're not confident that you're going to be able to continue as a going concern. I'm not going to go through the rest of them. They're all there on the screen, but again, I just have to reiterate that it's not necessary for all of these indicators to be present. If we look at companies today like Uber, Facebook for a period of time, any of those larger conglomerates were effectively trading in a position where they were using shareholders' capital to get to a growth period and I guess a economy of scale before they've turned into profitable businesses. Uber, it's contentious as to whether it's ever turned a profit, but ordinarily, if they didn't have access to those shareholder funds and they kept trading through that period without that access to that funding, then obviously that would be a indicator of insolvency. So really, again, what you need to take from it is it's a case-by-case basis. You need to look at every situation on its merits, and if a number of those things are in play, then the company or that person is potentially insolvent. So now what? Effectively, you've probably had conversations with some clients recently where they may have displayed a number of those indicators, and you're wondering what that means and how do you support them in terms of going forward. And if for whatever reason they can't be supported going forward, what are their options post that? It's really a difficult position sometimes for advisors to be in. The mental and I guess time toll that some of these positions bring on people, not just that are in the business themselves, but advisors, is something that's often difficult to deal with. And often people find themselves in a position where their family life and their family relationships are very adversely affected. They may enter into some sort of mental health issue that has cropped up because of the added pressures. And again, as advisors, we need to be careful that we aren't putting ourselves in a position where we are experiencing those difficulties because of a client calling and continually reaching out to us for assistance in these circumstances. So whilst we need to understand that, yes, we need to be there for our clients, we also need to take care of ourselves in that perspective. And I'll touch on a few of the resources that are available to both clients and ourselves in those circumstances later in the presentation. But in terms of practicalities, and I'm probably not telling anyone anything new at this point in time, but there's a range of basic considerations that we can think about, not just as accountants, but as people in general. And the first one is really being a sounding board. In my experience, a lot of the times where people come under financial stress, they panic straight away. They get to a point where they go, okay, I can't deal with this. It's all getting too much for me. Help, help, help. And what I have done in the past in those circumstances is literally sat on the end of the phone and just listened. If you just listen to people that are in those predicaments, often just getting that worry off their mind brings them to a point where they become a little bit calmer, and you can think about strategies that you can put in place where you can potentially show them there's a light at the end of the tunnel and that you can work through those particular issues that they've broached. A lot of people find it difficult to to get to that point without having that panic stage. And I find by just listening and supporting those particular people through that process of them getting it off their chest, it generally gets to a point where you can look at some concrete changes that can be made going forward that will assist them and show that you're supporting them through that process. So that's the first tip. Always listen first before you start to provide answers or before you start to provide options to them. Again, I don't know what it's like in your networks, but a lot of my clients are actually now close friends. So it's not just the client relationship, but also the personal relationship that comes through there. And obviously as a friend, you're trying to support them in any way possible. But listening is the key to that in any circumstance in the first instance. The second thing I can raise is leveraging your network. We as accountants and advisors obviously have quite diverse networks. We have plumbers that are potentially our clients. There might be an electrician, a builder, anyone that you have that has some sort of cross referral potential is someone that you should be reaching out to within your network to support your clients. If you've got the ability to put a plumber in touch with someone who needs their bathroom fixed, just that simple connection and that, oh, look, I've been speaking to Joe down the street, he needs this fixed. Why don't I put you guys in touch? Perhaps you can do some work for them. That just shows that you're going above and beyond and you're thinking about adding value outside of just putting some books together and doing their best once a quarter. That is highly helpful in terms of providing some confidence to that particular client. And again, showing that you're not there just to do the books once a quarter, you're there to help them in terms of building their business. The third thing is providing access to specialised professionals if it's something that's outside of your area of expertise. I don't do my own accounts myself. I practice in the insolvency space predominantly, and I refer my own accounting work out to one of my clients actually, because I'm not a specialist in that area. I'm a specialist in turning around businesses and potentially going through formal insolvency processes. So that's the way that I approach that in my own life. And obviously you guys are great at the accounting side of things. Some of you might be specialist bookkeepers. Some of you might be specialist tax agents. If you're in an area that your client has a problem with that you don't necessarily have the expertise to deal with directly, put them in touch with someone that does. And again, coming back to your networks, everyone has those particular people in their networks. And if they don't, they've got the ability to find out the right person to talk to. So they're really the 101 tips in relation to what you can do in terms of supporting your client. Now we'll talk about the accounting side of things more generally. Often when I walk into a situation where a client's in financial distress, the first thing that I notice is that there's issues with cash flow. Generating cash is the number one requirement in these circumstances. So we all know that cash is king. One of the most overlooked areas that I see in businesses that are in financial distress is debtor collection. And whilst I know that sounds quite basic, a lot of people are really afraid to ask, hey, you've passed your 30 days, you've passed your 45 days, you need to A, tell me what's happening, or B, give me some sort of time frame as to when I'm going to be paid. You've done all the hard work as a supplier, you've issued the goods, you've done the work. You should, by rights, be getting paid just like everyone else. I've got a circumstance at the moment where I'm working with a wine distributor, and he's done all the hard work, he's made the sale, supplied the wine, the clients loved it, and yet the client's 40, 45, 90 plus days in terms of paying his invoice. And the first thing we did was we went into the business, we implemented a more structured debt collection process. So effectively the client gets a message 30 days after the initial invoice has been issued. The accounts person rings up on that day and says, hey, you're past due, when can I expect payment? They diarise. If there's a period of time that, they might give them an extra 7 days depending on the circumstance. They diarise to follow up again within that 7 days. If it still hasn't been paid, it goes to a debt collector, and that debt collector then continues to pursue the debt for the client. Now, obviously there's considerations in terms of relationships in that circumstance, but by setting those expectations with your customers, you get to a point where it just becomes automatic knowledge that they need to know that they pay you within the trading terms, or get on the phone and tell you why they haven't, and make good from that perspective. So that's one of the key areas that I see in circumstances where people are struggling, that they haven't looked at implementing a better process, or they haven't got on the phone and asked that question. Now, I appreciate we're in quite difficult times at the moment, but anecdotally, I was presenting to the Australian Credit Forum about 3 weeks ago, and they said to me that their collections had been up by 30% in the last 3 to 4 months, simply because there was so much stimulus out there that people were actually paying their bills prior to their trade terms, and even getting in front in some circumstances. So whilst that stimulus money is out there, now's a good time to be raising those things and saying to your clients, hey, get on the phone and start pursuing those things, because chances are you'll get paid quicker than you ordinarily would if you're not pursuing them. The other things obviously they can do there is looking at offering short-term discounts. So they pay well within their trade terms. They might get a 4 or 5% discount. Again, different terms for cash on delivery, if that's still something that's relevant in the business. There's also some other ways you can generate cash by liquidating surplus and obsolete stock. Whilst you might be getting amazing results in that regard, it does turn those things into cash, and there are plenty of auctioneers out there that are looking for work at the moment that would be happy to take those things off your hands and sell them online and distribute the net proceeds back to the client. So that's something to consider. Selling surplus assets, again, there's quite a buoyant market at the moment for a lot of secondhand machinery. I know a number of valuers I deal with are chasing me for opportunities to sell things, because a lot of people, I guess, are sitting at home and getting click happy and not being able to spend their money traveling or doing other things. So they're looking at equipment investments or cars or things of that nature. So that's something to think about. And then finally, considering other finance facilities. There's debtor factoring arrangements that you can look at. There's sale and leaseback of equipment that you can look at. Or all of those things can be used to generate so obviously some short-term cash and longer-term cash in terms of the debt collection side of things that will be beneficial in a circumstance where a business is struggling. Again, another way we can look at increasing the cash available is by deferring expenditure. A lot of the larger businesses out there today obviously extend their credit terms and push out their smaller suppliers over a longer period of time. And whilst I don't agree with that from a moral perspective, it is deferring cash paid right now to a future point in time. And if you can come to an arrangement with your suppliers to push out those payment terms, and obviously it keeps cash in the business right now, you're still going to have to come up with a way to pay it at whatever future point it becomes due and payable. And that's something that you need to look at in the long term. But in the short term cash crunch, that's one way of deferring expenditure. Obviously, what's happening at the moment in terms of the COVID situation, there's that much rent relief packages from the federal government around stimulus, cash flow boosts, the JobKeeper, deferment of bank loans that the Australian Banking Association have put through now to April next year. There's so many opportunities for us to advise our clients around the deferment of any of these particular expenditure items. Rent again is another big one that we can use to hold the cash that we've currently got for the expenses that we need to pay, whilst putting together a plan to try and reopen once the COVID crisis passes. So I'd encourage you to look at all of those particular measures. I'm sure you already have. And I was talking to Eric earlier. He said that there was a JobKeeper seminar that you guys had recently that you probably could have, the presenter could have probably answered questions for 2 hours on, because there's that much out there and that much changing so quickly that we need to be across to be helping our clients in terms of supporting them through this period. The ATO is another area that you can look at in terms of payment arrangements. They're quite lenient when it comes to accepting payment arrangements at this point in time, which I'm sure you've all come across. But again, that's something you can look at utilising. And informal arrangements with creditors, which we'll go into a bit more detail around later, is also something that you can look at to defer your cash and keep it in your client's business until there's a better idea as to how the economy is going to reopen, hopefully sooner rather than later. I might just pause there for a second. Eric, have you seen any questions that have come through there that anyone's raised?
I have one just appeared in Q&A. This is from Jody Watkins. If a client has a big tax debt and suppliers to pay, should they try pay off some ATO debt first or pay suppliers?
Yeah, thanks for the question, Jody. It's a tough one. The ATO, whilst they're happy to enter into payment arrangements and obviously support those, in most times if there's a concerted reason for them to do it, i.e. there's been some issue within the business that caused some sort of short-term cash crunch, or obviously in this circumstance COVID, which seems to be implying a longer-term cash crunch, they will enter into those payment arrangements, and they will continue to support businesses as long as they're making the payments that they've entered into. So really it's a juggling act between, okay, are we going to be able to continue to meet these repayments or are we not? Now at present, the way that the insolvency laws have changed under the Corporations Act, there's a change, and I'll get to it shortly, but since you've raised the question now, we'll touch on it. There's a change that effectively defers the time period that a creditor can issue a statutory demand against a supplier for goods that have been supplied to them but not yet paid for. And the amount that that is required to be owed before a creditor can push the button and issue that kind of demand is increased from 5,000 to 20,000 for a business, and 3,000, sorry, the other way around, 3,000 to 20,000 for an individual, and 5,000 to 20,000 for a business. So, and even if they do issue a statutory demand, the business has 6 months within which they can take to deal with that particular statutory demand. So it's a juggling act between, okay, knowing that the person who issues a statutory demand to chase that bill has 6 months within which they need to wait before they can pursue for it through a court process, or knowing that you need to enter into a payment arrangement with the ATO, and whether you can make good on that particular payment arrangement is really a question that the client needs to answer directly, and whether by entering into that arrangement, they're going to be in a position where they're defaulting on it, because defaulting on payment arrangements is an indicator of insolvency, which again leads back to our original indicators of insolvency that we talked about earlier. I can't make that decision or tell you what decision your client needs to make in that circumstance. All I can say is that at present, either or of those particular decisions will be made, and the circumstance of the outcome will be what it'll be. Just know that there's that statutory protection for the 6 month period within which a creditor can't commence proceedings against another creditor at this point in time. And we'll come back to that a little bit later in the presentation because there's some more slides that we'll look at there. But thank you again for the question.
So I don't have any other questions there at the moment, apart from Simone, who's said great tips. So if you want to keep moving on, that's fine.
Thanks, Eric. Thanks, Simone.
Can I just sort of mention, any questions need to go into the Q&A as well, please. Thanks.
Okay, right. Now we're going to look at, we've dealt with the basics in terms of cash and holding on to cash and deferring expenses. Now we're going to look at some long-term analysis and what we should be looking at post this month to try and understand whether our client's business is going to be able to continue as a going concern. And then how do we look at developing a plan to pay down any deferred debt that we've made or identify any other changes that may be made to the business that can decrease the expenses and turn around its overall performance, and whether we've got any other key stakeholders out there that might be able to throw in a capital injection or allow us extended payment terms so that we can implement the long-term cash flow strategy and monitor and make sure that that the business has a way forward. As I said, the first place that we need to start is by looking at compiling or adjusting, if we've already got one, our present long-term cash flow strategy for the business. Although it's difficult at the moment to try and come up with that particular cash flow analysis, and I appreciate the reasons why, we need to start somewhere. And if that exercise leads us to a point where we go to our client, look, here's the best position we put forward. There's a few options you've got here. We can look at implementing it and monitoring it on a week-by-week basis so that we're on top of the position as it changes, because obviously it's quite fluid at the moment. And we'll continue to monitor that. And if the cash flow position deteriorates quickly or rapidly, then we need to really reconsider what our options are for going forward. But again, that's the first thing I'll be looking at doing. Some clients that I've been speaking to are actually doing it on a daily basis at the moment because things are changing so rapidly. But a lot of them are looking at it on a week-to-week basis, and some weeks where they're completely blowing out their cash flow and making a lot more in terms of income than what they'd anticipated, and there are other weeks where they're completely off. So as long as we're continuing to monitor that situation and we're continuing to understand what our current cash position is on a weekly basis, that at least puts us in a position where we can make informed decisions about what we're doing going forward. It also helps us in terms of our clients' insolvent trading requirements in terms of their duties as directors, which we'll talk about in a little while, and making sure that we're on top of those so that we're not trading whilst we're insolvent. The other one is looking at developing or continuing to develop a plan to deal with any deferred debt that we might have looked at as part of our cash structures that I talked about earlier. If we have deferred that debt, we just need to make sure that's included in the cash flow analysis and that we're accounting for it on that weekly case-by-case basis and looking at our circumstances or our client's circumstances in that regard. The fourth thing that is good to be looking at the moment is whether there is the ability to access any additional capital or get any additional key stakeholder support. So again, as I mentioned earlier, talking to our financier, looking at getting our payment terms deferred or just converting from a interest and principal loan to an interest only, if that's something we can do. The banks are being very accommodating in that space at this point in time, and obviously landlords, in terms of our rent reduction that we talked about earlier under the federal code that the government had implemented post-March, looking at what we can do in terms of our employees, those that are on JobKeeper. We can also take advantage of the Fair Work Act amendments that allow for hours to be reduced if required without penalty. And then again, ATO payment arrangements, key suppliers, whether we can enter into some sort of arrangement with them in terms of our continued supply and any debt that we've accrued with those at this point in time. There's a myriad of things to be looking at. If we come back to our long-term cash flow analysis and making sure that we're on top of that on a weekly basis while talking with all of these stakeholders and potentially seeing whether there are other people that are willing to invest capital to give us that additional buffer while we wait this out. All of those things are things that we should be talking to our clients about at the moment in terms of going forward. The last thing that I'll emphasize in this particular area is communication. Communication in any circumstance is key, but in circumstances where there's so much uncertainty is just absolutely critical. Even if we've taken all of those steps around conserving our cash, deferring our expenses, looking at our long-term cash flows, if we're not communicating that to the stakeholders that are involved, there's no point in even continuing down that path. It only takes one person to not be on board effectively for all of these well-laid plans to be in a position where they might get railroaded and effectively derailed. Being proactive and making sure our clients are on the front foot with their suppliers and with their customers, and they're talking to their financiers and they're looking at their cash flows and they're talking to you as advisors is critical in making it so that these clients and businesses can get through this period. And look, unfortunately, some of them aren't, and some of them probably wouldn't have even if we didn't have COVID. It's just the nature of the process and the communication piece that we need to make sure that that those things are regular, informative, and that we're corresponding with all of these key stakeholders. And us as accountants and business advisors are critical to ensuring that we keep our clients honest in that regard as well. Okay, so that deals with, I guess, the practical examples in terms of assisting our clients, what we can do from cash flow perspectives, from an accountant's perspective and a communication perspective. Now we're going to look at some of the legal obligations in relation to businesses that are trading or may trade whilst they're insolvent. And there's a few considerations here because of the law changes that were implemented in March and have now just been extended until the end of December this year. But that just happened last night, so I'll talk through those in a little while. But if we go back to pre-COVID times, Section 588G of the Corporations Act effectively says that a director mustn't trade a business whilst insolvent. There are various penalties that obviously arise from that, mostly civil, but sometimes criminal, depending on the circumstances. Okay, so we mentioned earlier, a company is insolvent if and when they cannot pay their debts a company is insolvent when they can't pay their debts as and when they fall due. Before a director incurs a new debt, they must consider whether they have reasonable grounds to suspect that a company is insolvent or will become insolvent as a result of incurring that debt. So that's effectively a client that's running a company needs to consider whether if he enters into a contract to buy 5,000 widgets from Widget Co for $50,000, by entering into that contract, that's going to put his business in a position where it can't pay its debts as and when they fall due. And they need to be cognizant of that at any point in their business life cycle, at any time that they're entering into those particular arrangements with any party. And whilst COVID has thrown a spanner in the works and there's some amendments around the Corporations Act that discharge a director's personal liability from trading whilst insolvent in certain circumstances, fundamentally, it's something that a director needs to be aware of when continuing any part of their business at any point in time. A director needs to understand the financial position of a company, not just when they sign off on their yearly accounts, but they need to be constantly aware of their financial position at all times, which, if we go back to the cash flow position that we were looking at putting in place and the cash flows that we're looking at on a weekly basis, a director should be across what the company's position is at any point in time. And obviously now with Xero and QuickBooks and all of those accounting systems that are cloud-based that pull data on a real-time basis, it's getting harder and harder for directors to argue that they weren't aware of the position of the company. And in fact, it's not even a defense to insolvent trading these days in any case. So it's, in terms of the obligations for us as advisors, there's no legal obligation for us to report suspected insolvent trading of a client, but under the code of ethics for most of our major accounting bodies, CPA, CA, IPA, they all prescribe to the position around non-compliance with laws and regulation. And ethically, we as advisors need to think about whether, in circumstances where our clients are not complying with laws and regulations, whether that usurps our client confidential privilege position, and whether we should be considering raising that with someone like Asic, because it's in the public interest overall for us to do that. Now, practically, when would circumstances be like that where you would consider doing something like that? It's quite grey. Obviously, if it's outright criminal and for whatever reason you've come to the knowledge that there's criminal activity behind whatever's occurring as part of the accounts, you're in a position where under the ethics rules you should be reporting that to Asic. Myself as a liquidator, I have different requirements. I need to report anything that I see as part of my discharge of my liquidator's duties to Asic. So whilst I'm slightly different to a regular accountant in that circumstance, I'm also cognizant of the ethics requirements there as well. So again, just to summarise, it's not strictly something that we're legally obliged to do, but we need to take into consideration the ethics requirements as part of our membership to our professional associations when considering whether we need to inform Asic of circumstances like that.
There are a couple of questions there if you like.
Sure, go for it.
Okay, from Donna, I've got regarding legal action taken against a client for an unpaid debt.
Mm-hmm.
Are there allowance/deferrals at the moment due to COVID, or will it rely on the actual agreement contract relating to the original purchase of the goods?
So we're going to touch on that in a little while, Donna. So if you can just hold fire for 5 minutes, or there's a couple of slides I'll get to shortly that'll go through that.
And I've got another one here that says, what recourse is available to small business which cannot collect their receivables from big contractors? The small business cannot stop their supplies to big contractors for fear of breach of contract. Yeah,
that's a very, very difficult one. There are remedies that are available in terms of the ACCC and a few other places where you can look to enforce on those sides of things. But practically from the corporation's perspective at the moment, again, that falls under the changes that the government have implemented around the statutory demand process and pursuing debts, which again, in 2 or 3 slides time, I'll get to and explain in a bit more detail. But unfortunately, small business finds itself in a very, very difficult position at the moment because really they can't enforce for a 6-month period, even if they go down the legal path.
Okay, I'm not exactly what Donna's asking here, but it was throw debit interest to be charged. So I might just get her to redo that question. And from Edward is, if the only form of liquidity is a personal loan from a director, is the company still trading insolvent?
It depends on the director's position. If they're going to continue to support the business and provide liquidity, there's an argument that it's not. If that loan's not collectible and the director doesn't have sufficient assets to meet that loan, there's an argument that it is. So it depends on the circumstance. And I'm happy to talk to him offline about his particular circumstance if he likes, and give him a bit of direction around that.
Okay, and I think that Donna's clarified hers that should read, for any debit interest to be charged on the outstanding debt. So I think she's asking about interest and so on at the moment.
So in terms of interest deferrals, not that I'm aware of at the moment. The banks have come up with their own code of conduct around and their own, I guess, strategy around deferring loan repayments at the moment. I don't think it includes deferral of interest, and I don't think deferring interest from a regular contractual perspective is something that's able to be done. It's not collectible per se right now, but at some point in the future, when the insolvency laws change back, it'll be collectible just like any other debt if it's included in the contract.
Okay, that looks like about it for the moment. I'll let you go again.
Perfect, thanks for that. Okay, so we've talked through the legal obligations from that side of things, from an accountant's perspective as an advisor, and obviously from a director's perspective. And as I noted earlier, we'll go to the amended insolvent trading provisions shortly, along with the statutory demand and debt collection provisions as well. Here it is. So, as I've flagged, and obviously Donna's raised the question around in terms of chasing debts from larger or smaller suppliers, it doesn't matter in this circumstance, but effectively, under the regular Corporations Act and the enforcement procedures included in it, a debtor could issue a stat demand to a company if it was owed $2,000 or more at any point in time. So that's effectively a legal document that says, I demand that you pay X amount of dollars within 21 days of the issuance of this notice. Otherwise, we are in a position where we can approach the court, get a default judgment against you, and take proceedings to wind up your company. So it was 2,000 instead of 3,000. My apologies from my previous note. It's now been increased to $20,000. So the debt owing needs to be an amount of $20,000 or more. And rather than 21 days to comply with that notice, a creditor has 6 months to comply with that notice. Now, originally that temporary amendment to the Corporations Act came in on the 24th of March and was due to finish on the 25th of September. Just today, I was talking to Eric earlier about this. They've now extended that moratorium through to the 31st of December. So what does that mean for a small business client trying to collect a debt? They've got to be owed more than $20,000 by a company. If they issue a statutory demand, the company that they've issued that statutory demand on to get payment for their debt has 6 months within which they need to comply with that statutory demand. So if I issued it today, in 6 months' time, if I received that today, within 6 months, I need to deal with that debt by either coming to some arrangement with the person who's issued the demand against me or paying it in full, depending on the circumstances, rather than what ordinarily would be 21 days. Now, that's a huge impost on anyone trying to collect a debt at all, let alone the increase from 2,000 to 20,000. Having to wait 6 months before you can enforce on that amount is terminal for some businesses, and we've seen that already in a number of circumstances. And the longer this gets delayed for, the more businesses are going to suffer because of it. Similarly, from a bankruptcy perspective, if an individual owes you what ordinarily would be $5,000 or more, you could go through the same process. That amount now is also increased to $20,000. and the time frame within which you can collect has gone from 21 days to 6 months. So it's really, really difficult for people to enforce on amounts that are outstanding at the moment. The other amendment that was made to the Corporations Act under this economic response to COVID-19 was the director's personal liability for insolvent trading being paused. That's what I mentioned earlier in relation to a director's considerations around insolvent trading and whether incurring a debt would put the company into a position where it was insolvent. Whilst that's been paused in terms of any personal liability that may attach to it, it's only in certain circumstances, and there are a myriad of other directors' duties in section 181 to 183 of the Corporations Act around acting in good faith in the interests of the company and with due diligence that at some future point will probably come out as a way of getting around that insolvent trading pause from a liquidator's perspective, because essentially those duties overlap with the requirement to not trade a business whilst it's insolvent. Whilst they're more difficult to prove from a liquidator's perspective, they're effectively portions of each of those sections of the Act interact with each other, and they can't be separated by simply pausing the insolvent trading side of things. So directors just need to be very careful about documenting the reasons why they entered into a transaction that might put them in a position of insolvency, and being able to document that at the time that was in the best interest of the company, and that it wasn't likely to put the company into a position where it was insolvent, even if in fact it eventually did. So they're just two of the amendments that have been made to the Corporations Act that I noted have been extended until the end of this year. And there's obviously some pitfalls around both of those, and some maybe unintended consequences around the effects that it's got on a large number of other businesses in that they can't collect their debts for a 6-month period, which I think myself is ludicrous. But in any case, that's where we are at the moment. I think I'm coming to a point now where I think I'm going to go a bit over time. What I might do is open the floor for questions at the moment. I'll circularise the slide pack here, and in that slide pack there's a listing of the different types of insolvency appointments and how to go about them. It's pretty self-explanatory, but I'm also happy to come back and continue this at some future point, knowing that I'm kind of stepping over the time constraints at the moment.
Yeah, I've only got one other question right at the moment, and it's from an anonymous attendee. It says, where does a partnership fit in here?
So partnerships effectively fall under the same moratoriums as an individual. It's not a company for the purposes of the Corporations Act. So a debt would need to be $5,000 or more, or $20,000 at the moment, and they'd still have to enforce over a 6-month period rather than the regular 21-day period.
And there doesn't seem to be anything else at the moment. So.
Okay, well, maybe I'll just quickly skip through a few of these slides now, and we can talk about some different types of appointments. So if we go through all of these processes and we get to a point where your client just simply doesn't have the ability to continue to trade on, there's no cash, there's no ability to turn the business around, what do you need to understand? So there's some informal arrangements that you can potentially enter into with clients if they have a limited number of debts owed to them, or if they've got 2 or 3 creditors. Effectively, you can pick up the phone and say, look, here's the position I'm in. Here's my asset and liability position. I'm not in a position to make these payments to you now. Why don't you give me 6 months of X dollars per month to make those payments? If we can go through that and agree to that process, I'll pay down those amounts owed to you over a 6-month period. If I've got 2 or 3 other creditors that are in a similar position, I come to an informal arrangement with them. Great, everyone's happy. As long as I meet the repayment arrangement, no harm, no foul. It's at a point where there's more than 2 or 3 creditors, there's large amounts of money that are outstanding. There might be 50, 100, 200, 300 grand owed to the ATO. I've got a bank in there that has security over the assets. What do I do about it? That's when the formal insolvency processes come into play. And that's where appointing a liquidator to go through one of those formal processes is the best option for your client at that particular time. Again, case-by-case scenario. There's not a one-size-fits-all. A voluntary administration process and some sort of restructure via a compromise of the debts might be the best approach. If there isn't the ability to do that and there are insufficient assets to do that, or contributions by a director or shareholder, then a creditor's voluntary liquidation and a formal wind down and shutdown of the business might be a better way to approach it. In the balance of the slide deck here, it explains and just outlines the timeframes and the ability or the process of appointing a voluntary administrator or a liquidator. And again, I'm happy to answer anyone's questions, whether it be offline or come back and finalise a further bit of the presentation for you to get through those given time constraints.
Well, there's just a couple here at the moment. I've got more of a comment than a question. It would seem the best thing to help businesses to keep the money flowing is that those who have the money should pay.
Yeah. Well, that's always the case. It doesn't matter if there's a COVID happening or not. Everyone should just be doing the right thing, but unfortunately that doesn't always occur.
And Simone's asking, how can a bookkeeper help with the insolvency work, or do they just step away at that point? In reality, the bookkeeper probably won't get paid either.
As a liquidator, I try and keep the accountant or bookkeeper involved in the process, simply because they're closer to the financials than I'll ever be. So if there is sufficient funds in the appointment to be able to engage the bookkeeper to get the books up to date or to assist in the process, and that's something that definitely we'd be looking at. There's ways, and it's probably for another presentation, there's ways where accountants or bookkeepers can try and secure their outstanding payments. It's a legal question that's, again, probably a story for another day. So I'm happy to send her some notes around that if she's interested in understanding that a bit more.
Right. And I've got debt arising from unpaid super plus penalties where only the employees are the directors.
Yep. So under the changed insolvency laws that came into effect, I think it was middle of last year, pay-as-you-go withholding and superannuation, and now GST as of the 1st of April, are all personal liabilities for a director. So effectively, if those amounts aren't remitted and paid in time, lodgements aren't up to date, those amounts outstanding will become personal liabilities of the directors, and the ATO can issue what's called a director penalty notice to the directors personally to pay those outstanding debts. So even if they are the only employees in the company, the way that the debt has arisen is via a superannuation requirement, and effectively that'll end up being a personal liability of the directors.
And an anonymous attendee would like to know, how does the liquidator get paid?
So a liquidator generally gets paid out of the assets of the entity that are available to it. Sometimes there aren't any assets, and the liquidator may get paid by a indemnity contribution provided by a stakeholder, whether it's a director or a financier, depending on the circumstance. Effectively, you go through the realisation of the asset process. That the liquidator has a priority under Section 556 of the Corporations Act. Then the employee entitlements, any super wages that are outstanding to unrelated employees, and then unsecureds and secureds, depending on the way they're secured, kind of fit into that schedule as well.
Okay, and that's it there for the questions.
No problems. Look, I'm happy to keep going, but again, I'm cognizant that it's 1:01. If you can give me 5 more minutes, I'm happy to flick through the next lot of slides. Otherwise, I'm happy to end it there and come back at some future point.
Well, we seem to still have the same number of participants there, so I'd say they'd like you to keep going.
Perfect. I will definitely do that. Thank you for the indulgence. Okay, so in terms of understanding the formal insolvency processes and how they work, we'll go through those in a minute. We'll just touch on the informal solutions, which I tried to rush through a little bit there earlier. But effectively, in order to enter into agreements with creditors of a company, there's not necessarily the requirement for a liquidator to be appointed or an insolvency practitioner to persist. It's effectively you negotiating as a business owner with the people that are owed funds by your company or you personally. Now, they generally work best when there's a small number of creditors, as I said, 2 or 3, 4, 5. Yeah, you can probably get away with them as long as you're communicating, you've been upfront, you've provided some documentation to support what you're trying to do, and everyone's on board. Then it's just like any other business arrangement. Effectively, you've said that you'll make 5 payments over 5 months of $1,000 each, and you make those 5 payments and all 5 payments to all 5 creditors, everyone's happy, there's no issues, then effectively you've solved your problem. When people try and enter into these informal arrangements with a larger pool of creditors, that's when it becomes a bit more problematic. Effectively, the larger the number of creditors, the harder it is to get everyone to agree informally. They might be having their own cash flow problems. You, for whatever reason, they might be able to view that your client's not being honest about where they're at. And in terms of the ATO, for whatever reason, you may have previously entered into a payment arrangement with them, or your client may have entered into an arrangement with them and defaulted on it, so they're not willing to participate either. That in those circumstances, it's, as it says there on the slide, like herding cats. It's very, very difficult to get up with an informal agreement. And that's when you really need to start thinking about, well, do I look at the formal side of the insolvency process? Again, some other things to consider if you're looking at the informal side of things is that it often takes some time to get these processes set up. You may not have that time. Creditors might be pushing you for payment. In this circumstance, you could probably get away with a longer period of time in terms of putting an informal solution together, because people can't enforce on their debts at the moment. So I guess that's one of the benefits of the changes to the Corporations Act that could be utilised in an informal solution. But again, you still have to have all the creditors agree, as I noted. It's not binding on those creditors either in an informal circumstance. So you can make 4 of the 5 payments, and for whatever reason, one of the 5 creditors says, no, I'm not interested in continuing this arrangement anymore, pay it all to me now. And if you weren't able to pay it all now, then effectively the whole arrangement falls down. So they're just things that you need to be considering if you're potentially helping your clients try and put together an informal arrangement. Okay, so we'll jump now onto the formal solutions. Now, there's a number of different formal solutions. The first one we're going to touch on is actually a solvent winding up. So that's where you've gone through your cash flow process, you've got 20 or 30 grand that you can't account for at the end of the day, and your client says, well, you know what, I want to do the right thing. I'm just going to pay that 20 or 30 grand in personally, and then effectively we're going to wind up the business and go and do other things. So the safest way to do that is via a member's voluntary liquidation process. You can also go through just a deregistration process with Asic. There's some pitfalls with that I'll explain in a moment, but In terms of a member's voluntary, there's a couple of things that need to occur. A directors meeting first that makes or resolves to call a shareholders meeting where a resolution is put forward to wind the company up. As part of that process, a declaration of solvency form needs to be signed by the directors to effectively say, yes, the company's solvent. Here's the snapshot of the balance sheet. It might be $5,000 in the bank account, $3,000 to finalise a liquidation. There's a $2,000 distribution to the shareholders. We're all happy. Sign that arrangement, and lodge that with Asic. Hold the members meeting. A liquidator like myself, or even an accountant, CPA can be a liquidator in a members voluntary process, is appointed, and they write to the tax office, request a tax clearance to make sure all the tax lodgements are up to date, issue a notice on the Asic website saying they've been appointed, call for proofs of debt to see whether there's any creditors out there. If there are no creditors, which is generally the case, they will issue a dividend to the shareholders and finalise the winding up. So that circumstance assumes there's no creditors, that there's sufficient funds to pay everyone, and that all their tax lodgements are up to date. And if all those boxes are ticked, then you can deregister the company via the finalised winding up process. There are occasions where you will start as a members voluntary process and a creditor comes out of the woodwork, or there's a legal claim that comes out of the woodwork that necessitates the company not being in a position where it's solvent. At that point in time, it's on the liquidator to call a creditors meeting and convert that appointment from a members voluntary liquidation process to a creditors voluntary liquidation process. And we'll talk about what's involved in that in a second. Essentially, in this circumstance, though, you need your shareholders to agree, your directors to agree, and once those occur and those meetings occur, you can commence the process. The second one we're going to look at is a voluntary administration process. I touched on that a little bit earlier. Voluntary administrations have been around since the 90s. Effectively, their stated purpose is to ensure that there is a better return to creditors than would otherwise be if the company was placed into liquidation, or to allow for the business of the company to continue in some shape or form. That might be via a sale process, that might be via a deed of company arrangement process, which is linked to the better return in a VA scenario rather than in a liquidation scenario. And it also allows creditors to provide their input into the process and understand whether they support some sort of business restructure. Now, the way that works is via directors resolution. If it's a one director company, obviously you only need one director. If it's a two director company, you need both directors to approve the process. If it's a three director company, you only need two of the three to commence the process. So it's really dependent on the number of directors that at that particular time. Effectively, people
Yes, I think we might be losing you there, Andrew, or I might be. Yeah. I have a feeling, everyone, that we may have lost Andrew. Just a minute. Yeah, we're losing sound and so on. Are you able to hear me? Is anyone able to tell me that one? Yeah, we've lost Andrew's screen.
Oh,
Oh, there he
I'm
is.
back.
He's back.
Sorry about that.
Okay. We just had
Hang on
a
a second.
downtime.
Just cut out there for a second. Hang on. I'm just going to make sure. Am I still sharing my screen? Can you still
No,
see
the
it?
screen's gone off. Share.
Okay. Which one is it? Hang on.
There we go.
Is that you good? Perfect.
Yep, we're
Apologies
back.
for that. Just cut out. Okay, so in terms of that circumstance, the administrator gets his head around what's happening with the business, looks at the cash flows, looks at the asset liability position, puts a report together over generally a 20 business day period, issues that to creditors post a meeting of creditors. That then informs the creditors as to what the administrator has found during his investigations, details the asset liability position of the company and any kind of proposal that's been put forward by a stakeholder or the directors in relation to a restructure, and compares that to what would likely result via a creditor's voluntary liquidation process. And then it's really up to the creditors of the company to decide whether they take some sort of compromise via this deed of company arrangement process, or they vote to place the company into liquidation. So it's really a quick restructuring process, which allows creditors some input into it and some visibility around what's happened with the assets and the reason why the company finds itself in that position. There's a myriad of things that can occur during that process, and there's a whole range of different circumstances that may present themselves, but effectively that's a quick synopsis of the process and how it's meant to work. There's some benefits, there are some pitfalls. Unfortunately, it doesn't work as well as it was potentially intended for a smaller business because the costs of doing the process are a bit prohibitive. But again, there are circumstances, and there are a lot of circumstances where it is a useful restructuring tool. It also allows for someone independent to take control of the business and potentially try and get a sale of business away to an unrelated third party, or potentially a related party, depending on the circumstances, which might be able to keep the business of the company going and employees employed and suppliers with continued customers, etc. So it's a common form of formal insolvency appointment, and the one that's used in terms of trying to do some sort of restructuring of the business. The third and probably the most common form of appointment is a creditor's voluntary liquidation. And effectively that's when the directors and shareholders come to a view that the business can't continue and it needs to be orderly wound down. But unfortunately, there isn't sufficient assets or funds available to pay all of the creditors in full. Again, it's constituted by a resolution of members followed by what used to be a creditors meeting. That's no longer required under the Corporations Act, but in circumstances where there is a large number of creditors, a liquidator will generally hold a creditors meeting. It effectively is a wave the white flag, I'm appointing someone independent, they can report to the creditors and advise what's happened in the lead up to the appointment. They can put together a report that advises what the realizations of the assets are and whether there'll be a distribution to creditors, and they'll highlight areas of investigation or potential recoveries that may be available to them that are there to try and get some sort of return to creditors. As a creditors voluntary liquidator, I'm in the position where I need to act in the best interests of creditors, and it's really all about trying to get them some sort of return using the mechanisms that are available to me as a liquidator under the Corporations Act. So we'll go through a few of those in a second, but that I'm an independent third party. I'm appointed to the business, and I'm there to act in creditor's best interest. Whilst your client in these circumstances may be the director and there has been an appointment that has come via an accountant or a solicitor, my overall obligations are to the creditors. But the way that I like to approach these things personally is being very direct and upfront about what the consequences are for directors and what I've seen in the investigations that I've entered into as part of the appointment that may be leaving the director in a position where they need to justify some of their actions or might be personally liable for some of the things that have occurred prior to the appointment. So whilst it's not always palatable, if you're open and honest and communicate, that's where I find we get the best outcome for creditors, but also for the other stakeholders, directors and shareholders. The fourth one here I'll just touch on briefly is the court winding up process. If people remember from earlier in the presentation, I talked about the statutory demand process. If a creditor doesn't pay their bills within their trade terms, you apply for or you issue a statutory demand. If that statutory demand isn't complied with, then you can make an application to the court to have a court-appointed liquidator appointed to the creditor. And at that point in time, someone like myself would likely give a consent to a lawyer that's acting to be appointed to that particular company. And then again, it's a similar process to the creditor's voluntary liquidation process from a practical point of view. Some additional reporting requirements I have to meet with the court. But aside from that, again, acting in the interests of creditors to try and get some sort of return to them based on the assets of the company. And that's the way that court appointments work from that perspective. What are some of the realizations or recoveries that we can get or we can pursue, as a liquidator? Any of the assets that are owned by the company obviously are vest in the liquidator at the time of their appointment. Preference payments, which I suspect is probably an area that some of you and your clients would come across. If for whatever reason a payment arrangement's been entered into that is over and above what that particular creditor may otherwise expect if they didn't enter into that into that payment arrangement with the company within 6 months of someone like myself being appointed to it, I'm able to recoup those payments from the recipient. There are a number of circumstances where that is applicable. There also are a number of arguments that can be run by creditors in relation to defending those particular payments, and that's another presentation in itself. And again, I'm happy to talk to anyone about their experiences directly offline in relation to those, but that's definitely a common mechanism for recouping funds into an appointment. Insolvent trading damages actions. Again, directors might be personally liable for insolvent trading, and we talked about that previously. They just need to be mindful of what might occur should they enter into a certain transaction or continue to trade a business if there are insufficient funds available to pay creditors or assets available to pay creditors. In terms of uncommercial transactions or unfair loans, there are often circumstances where there's directors' loans that should be collectible that are pursued, or where there might have been a sale of business prior to the appointment that was for undervalue. Those things can be obviously turned over and pursued by a liquidator within a 4-year period for related parties, indefinitely if it's fraudulent, within a 2-year period for for some other related parties, and within a 6-month period for non-related parties. And there's also some other actions that I can take against the breaches of directors' duties and additional considerations like chose of actions and things that, again, pop up in certain circumstances. The last one we'll just quickly touch on is a receivership. You may or may not come across these as often in your practices, but effectively a receiver is generally appointed by a financier that has some sort of security over the assets of the company, and all of receivers' requirements are to try and recoup the funds that have been owed or lent by the secured creditor to the client or the company. They don't have to hold meetings or anything of that nature. They have some requirements in terms of selling assets for market value, but aside from that, really they're just acting in the interests of the appointor. So whilst it's common in some circumstances, in a small business perspective, it's not generally something that you would see every day. Okay, now that we've got through the appointment types, who are the key people that are supporting businesses through insolvency? So my practice, in my experience, accountants, bookkeepers, and solicitors are the key professionals that are supporting people through these insolvency processes or through a process where they're trying to assist their clients out of some sort of financial difficulty in general. Again, there's difficult decisions that need to be made by directors and accountants and lawyers that are advising those particular directors are generally the people that are supporting them through this process. It's never easy to have those difficult conversations. If you've go back to earlier in the presentation and think about the processes that we looked or went through about listening to the client, understanding what their position is, looking at some simple ways you can conserve cash, looking at some other ways that you can potentially take advantage of the stimulus that's out there, deferring creditor payments, entering into arrangements with those particular creditors. All of those things, if you've gone through that process with a client and you get to a point where it's still not in a position where it can continue to go as a going concern, at least if you've gone through that process, these conversations are a little bit more, I won't say easier, but they're a little bit more understandable and a little bit more approachable to have. Often, just from a personal perspective, all of the intense pressure and stress and all of the things that go with being involved in that process can have a detrimental effect on all of the parties. The mental health side of things in Australia overall, let alone in a professional circumstance, has never really been dealt with that greatly. It's better than a lot of other countries that I've had the fortune of visiting, but unfortunately there's still a ways to go in terms of dealing with mental health problems and stress that often comes from financial problems. A lot of the circumstances where I find myself involved in a small business, there's drug problems, there's gambling problems, there's marriage breakdown, there's all of those issues that are personal issues that kind of blend themselves into financial and business issues, and they're never very easy to talk about. But again, listening, being empathetic to your client's cause at that point in time, and making sure that you take care of yourself in those circumstances are all paramount to getting to the best result for the particular client that you're dealing with in terms of their circumstance, and also in maintaining your own mental health and ensuring that you're able to provide that support for other clients going forward. Our staff, I've had them undertake some mental health support training already. There's a whole range of services that are available. The mental health service of Australia has some very good detail available there. The New South Wales Health Service also does as well. There are people like Lifeline and Beyond Blue that are available for both your client and yourselves to talk to. They're all confidential and supported by the government in a number of circumstances, so they often don't cost anything to access. So I've just left some links there in that regard. I myself come across these circumstances in every day that I'm in the office, and I've always found that making sure that I take care of my own mental well-being and that I'm supportive and listening to the people that are obviously having these difficulties without trying to take it on board myself, which is very difficult, are all things that have helped me be successful in my practice. And if you're able to implement those things into your own practice, they'll put you in good stead to continue to be successful in yours from that perspective as well. The last few slides are really just about our firm, Worrells, overall. I'll leave those for you to look at in your own time, but we're obviously available 24/7. My mobile phone's always on, although I prefer you to call me sometime before 6 o'clock most days. If for whatever reason it's an emergency, I'm always happy to pick up the phone and talk through any circumstance that you might find yourself in with a client. And from that perspective, if you're looking for some more detail about insolvency, we put together a guide once every 6 months from a personal and from a corporate perspective, which is always handy. That's available to download from our website. It's free of charge, has all the details around those appointments I talked about, and obviously some tips and tricks around cash flows and those things as well. So I encourage you to jump on there and download that if you think it would be of assistance. And with that, I'll open up for some final questions, and thank you very much for your time.
Thank you very much for that, Andrew. You've kept people on board, so the number of people is still reasonably good. So that was excellent. Thank you for that. There were a couple of questions. One you sort of pretty much answered was one, how does a creditor protect himself from a liquidator's claim of preferential payments? But you said that was pretty much a story all of its own.
Yeah, happy to. My email address is on the last slide. Happy for you to send me a note and I'll pick up the phone and have a chat to you.
And another one was, how long has it been that creditors meeting is no longer required by law?
Since the changes to the IPR and the IPS came in, which is about 18 months now, you can, as a creditor, request that a meeting be held, but a liquidator doesn't necessarily have to hold one. There's some parameters around that. And again, please flick me a note and I'll send you the relevant section so you can look at it.
And all of the final questions are all saying many thanks to Andrew. Thank you, very informative, and thank you, Andrew. So at that, I think that we can probably call that a day on the session. So thank you for everybody attending. Thank you, Andrew. You've been really informative and you've kept the audience participation there. So obviously it was a subject that was very important to people. So thank you again, everybody, and hopefully we'll see you at the next one.
No problems. Thanks, Eric. Thanks, everyone.
Lots of thank yous coming through now.
Oh, that's good. I'm glad people found it informative.
Yeah, it was. Here we go. They're all disappearing now. So, okay. All right. Well, thank you again, Andrew. We will maybe catch up in the future sometime.
No problems. Do you want me to send the slides through so they can be sent around?
You can send those through, and then Michelle can probably issue those out to the people that are there. So that would be great. And I think we've got this recorded. I started the recording a little bit late, but I think we've got most of the information on there now, as they may be able to go and have another look at it. So,
great.
All right. Well, thank you again, Andrew. We will see you later on.
No problems. Take care.
Bye.
Bye.